welcome you all to this is very exciting session of on World Savings Day. Incidentally, it's also Halloween today, so I don't know which one is going to be, but I'm going to stick with the World Savings Day. It's actually I did not even know until recently that today was World Savings Day, and it got us thinking on how do we give savings a little more push. And that's why our second webinar on pinBox webinar series is on savings and social protection, COVID and beyond. Um, I think COVID-19 is the single most consequential event of our lifetimes, and it has disrupted, dislocated incomes, labor market, savings, and consumption, and has affected every single person on this planet. Self-employed women and youth, who constitute nearly 80% of the paid workforce across Asia, Africa, and Latin America, are excluded from formal social protection benefits and are continuing to therefore face a disproportionately higher level of economic and social stress due to COVID-19. Now, the pandemic has actually exposed this pervasive scale of economic and this vulnerability of the informal sector workers in a very stark light. The scale of the problem with systematic exclusion of non-salaried workers from formal pensions and social protection arrangements has actually never been so evident. But interestingly, billions of dollars have been spent over the last decade or so on expanding financial inclusion, on creating digital tools, plumbing products, ecosystems that can effectively address issues of access, friction, process complications that have traditionally prevented perhaps people in the lower income group or households from usually getting access to finance, to save, to borrow, to manage risks. Governments and regulators, finance firms, think tanks, development institutions, and social enterprises have been working hard to prove attraction and usage of this to get to this formal finance. But as we stand in the middle of this pandemic and look around us at the social and economic scale of this devastation, it has become clear that most non-salaried workers will either have not saved enough or are just not saving at all. So if there were, the extent of economic chaos and much of the displacement and the dislocation that we have witnessed could have been avoided or at least mitigated to a certain extent. Maybe citizens may not have depended so heavily or in many cases entirely on this fiscal intervention or support to tide over. They could have simply used their own savings to take care of expenses during this difficult time. The savings and outlook behavior remains unchanged, or so we are debating today. We will witness an exponentially larger or more sustained social and fiscal crisis once we are over this 1 billion informal sector workforce who will be without pension benefits, permanently drop out of the workforce in their old age in the next 2 to 3 decades. And at that point, poverty among the elderly will become the dominant cause of increased global poverty. This is clearly a highly complicated issue that requires well-coordinated responses by multiple stakeholders across multiple countries. It is therefore wonderful to have such a distinguished panel of global domain experts with us today to discuss exactly this. Where were we before the pandemic? How did we get here because of the pandemic on terms of savings? And where do we go from here? I am Parul Seth Khanna. I am a co-founder and director at pinBox Solutions, fintech essentially working on savings inclusion, pensions, insurances. And I'm delighted to introduce our first panelist, Dr. David Tusta. He's the ex-finance minister of Peru. And he's been an economist, the chief economist at BBVA. He's currently based out of Madrid. Hugely passionate about old age savings and pensions, and a keen interest in what governments and policymakers can do. He also heads our Latin America story. So we are very delighted to have you, Dr. Tusta. Second panelist is Greta Bull. As I was talking briefly earlier, she is the CEO of CGAP. And for those who don't know, CGAP is one of the most reputed think tanks. And I always call CGAP a think tank with a heart, because so focused on the issues with low income individuals, creating this whole help create this whole ecosystem of financial inclusion, and now focused on how to get financial services delivered to the last mile using this financial inclusion infrastructure. So warm welcome to you, Greta. We have Dr. Amlan Roy, a dear friend, a mentor. Amlan, I met him a few years ago. He is the senior managing director at Streets, based out of UK, one of the largest fund managing companies in the world. Amlan is hugely passionate about the macroeconomics, the demography, how our country's thinking about demographics, how are savings going to impact, how will the GDP be impacted. I've had some discussions with Dr. Roy on the theory of savings that I really want to hear more about on that from Dr. Roy. Another panel, our last panelist is a dear friend, Mr. Ayandev Saha. Ayandev and I have had the pleasure of, I've known Ayandev for maybe over a decade, and have the pleasure of working in India and in some countries in Africa. Amlan is a financial sector specialist. He is currently strategic and senior advisor to the Ministry of Rwanda, especially the Ministry of Finance and Economic Planning. He's been working on social security protection for several years, focusing on micropensions. He is an insurance expert, having worked on life and non-life, including agriculture. Insurance, worked in Asia and Africa extensively on implementation, on how to take programs to scale, how to keep people engaged in programs, and more so a ear to the ground on what the demand side is actually looking for. I also wanted to inform our attendees today. We regret to inform that our panelist, dear Jayashree Vyas, who is the CEO of Seva Bank in India, unfortunately could not join us today. She's feeling a little poorly. We wish her very good health, and we hope that she can join us for 10 minutes. She said she will try. Just to set the context again, on the first question that I want to pose to the panelists is on where were we and how did we get here on terms of savings before the pandemic? Do we have the benefit of the hindsight? Do we have something that we can learn from the past? Do we get better clues? Is there a foresight which can effectively solve the savings and protection gap, a social protection gap going forward? So Greta, the first question now. Over the last few years, billions of dollars have been spent on expanding financial inclusion, which has in turn helped pulled hundreds of millions of families out of poverty. But the economic distress of the pandemic that has caused within a few months, affecting every individual on this planet, talking about 8 billion people, clearly shows that most of the informal sector workers who were not saving and or not saving enough. So what do you think can be prevented for more optimum household savings across Asia, Africa, or Latin America, or developing countries?
Yeah, thanks so much, Parul. And it's a pleasure to be here with you this morning. I think I'm maybe the only person on this call who it's morning for right now. So it's a pleasure to be here. So, you know, I think we have to look at this over a long period of time. And I think you're absolutely correct that we've made a lot of progress on including more people in the formal financial system in the last 10 years. So, you know, between 2011 and 2017, we know that 1.2 billion people gained access to accounts, and a large number of those were low-income people in India and sub-Saharan Africa, right? So I think there's some progress to be celebrated, but I think we also have to note that we still have a pretty enormous access gap of 1.7 billion people worldwide. So there's a lot to do on just closing the access gap, mostly in sub-Saharan Africa and South Asia as well. Despite all this progress on access, though, one of the key findings of the 2017 Findex was that many of the accounts created in that time period remain dormant. As many as half of new accounts in places like India and also in sub-Saharan Africa, although this was not picked up in the Findex because of the way they did the measurement on mobile money accounts. So we not only need to close that access gap, we still need to find compelling use cases that will help people find utility in those accounts. And I think COVID may sort of change the equation on that. But on your question on savings, again, referencing Findex, in low and middle income countries in 2017, only 20% of the people they surveyed saved using a formal account. Now, that doesn't mean that people weren't saving. Lots of people save in the cash economy, but it does tell you a story about how effective accounts are as a savings tool. So we know that 43% of the sample saved money, but only 15% of those people saved long-term, i.e. for old age, right? So, there's a pretty big gap in people's ability to save and the tools that they have available to them that they find useful to be able to save. And of course, the real heart of the question is actually how resilient people are, right? And that's a particularly pertinent question for where we now find ourselves. And the Findex asked respondents whether or not it would be possible to come up with a sum of 1/20th of gross national income in their particular country in an emergency. Only 50% of people in emerging markets said that they would be able to do that. And less than 15% of those respondents said that that emergency funding would come from savings. So that's pretty scary and highlights the importance of savings, which is sort of the ultimate safety net. And, the literature is pretty clear on the development impact of savings. And if you'd like to learn more, we've got a lot of information on this on our website on our evidence and impact work. But, I think then it's worth asking why people don't see value in those accounts. And I think there are lots of different reasons for that, right? There's lack of trust. In many countries, you put money into an account and it just slowly diminishes over time. I've certainly experienced that in a couple of countries. And there's a hassle factor. Cash is just really easy and you can sort of stash it under your bed in a jar, whatever. But I think the more difficult problem is that from a provider perspective, there's just not perceived to be a great business case for capturing savings from low-income households. The amounts are too small to justify the cost of managing that account. We have some good examples. We have, banks that specialize in serving low-income populations, and those are an option for savings. And I think what the MNOs have proven with mobile money accounts is that you can manage light touch accounts for large numbers of low-income people and make the economics work. So if you look at M-Shwari, which is a partnership between M-Pesa and the Commercial Bank of Africa, which was the earliest and most successful of these products, they do prove essentially that you can build a business model that makes small savings accounts available to the poor, and you can make money doing it. I mean, CBA, by the way, went from being a small corporate bank to the largest bank by customer numbers in Kenya virtually overnight. So just a couple of numbers and then I'll stop. According to their website, M-Shwari provides financial services to over 31 million customers in Kenya. Their locked savings facility averaged about $82 of balance for an average period of 7.5 months. And in total, CBA held $172 million in savings through those accounts. So something there is working. What surprises me is we haven't seen more examples of this kind of partnership, although we're starting to hear interest in a few quarters for building something similar. But I think overall, it's still unfortunately the case that we don't see too many business models that are focused on really bringing savings options to people.
Thanks, Greta. I think I agree with you, and I would love for the attendees to also know a bit more about M-Shwari. It's a successful program in Rwanda, but also provides credit. I think that is also the credit and the savings angle. So I actually wanted to come to you, Amlan, on the macroeconomics of savings, but just one quick question before that to Ayandev. So Ayandev, you have worked just to taking a leaf from and the flow for what the stage that Greta has set for now. So you've had experience on long-term and short-term savings, but there is also this savings behavior and outlook among the informal low-income women, right? So is there a part that savings behavior needs to be done for the long-term and short-term? What has been your experience working on implementation in India and Africa on how the outlook has been on the behavioral side?
Yeah, thanks, Parul, and thanks, pinBox, for giving me this opportunity. I completely agree with Greta to a large extent, because one, as she was saying about accessibility and affordability, and as you are rightly mentioning about behavioral bit on both the saving as the short term and the long term. The reason is when you look into the informal sector, one of the biggest thing why they're not able to save is also a lot of shocks that they face during their life. more because of their associated risk, and they are not having insurance, most of them. So what happens, even if they save, they generally starts consuming it. So what is required is you need a different level of strategy when you are actually talking to the informal sector in terms of goals, objectives, and time dimension. And that is where the behavior comes in, right? So we can't ask them to save for a long term when his actual need is short term. And you can't ask them to actually start saving when he's not having an income sufficient. So I think all these components actually makes it a lot of sense, like to have a behavioral beat aspect, and which is more linked with age, gender, occupation, even the culture. Because if you see, when you speak of Asia and when you talk to Africans, you will see a different saving culture altogether. So I think all this requires to come into a behavioral aspect. So yes, an intervention, when you think of saving, behavior plays a very important role, and you need to have different strategies, as I said, based on different categories.
Any particular examples, Aindev, that you saw in India? I remember you worked on this incentive structure to increase savings. What were your findings there, just on the behavioral side?
Okay, so just let me take the example of pension. And Parul, I think many of the audience want to hear about pension, and pension is long-term saving, where people doesn't see any money or rewards coming in. So they simply start saving, and they continue saving for a long, long time, right? So if I start at the age of 25 and 30, I see retirement at the age of 55 and 60. So it's a long time commitment, and you don't see anything coming in. So there is no tangible benefit. So there is no demonstration effect. And sometimes, like, and I'll discuss later, like we started a program in Rwanda, and there also you see and the people are very young. So there is no people who are getting a pension at the start of the scheme. So you need to create an incentive structure. You need to create a reward structure. So if someone is continuously persistent, and then there can be a terms of reward, you can give something which motivates him to save. And there can be various ways of putting into that behavior bit. It can be a reward, it can be an incentive coming from the scheme. It can be a government's co-contribution. In many of the countries, government gives a co-contribution. It is one way of incentivizing them. So there are various ways you look into it. And as Parul, you mentioned, yes, we did something when we were actually targeting microfinance institutions. But in short, for a behavioral intervention or for any sort of reward, what you also need a very good data analytics. And for that, you need a tool, you need a system. If you are covering 1 million people in the informal sector and you now want to create a reward and recognition, this is not possible in an Excel sheet. You need some tools to recognize who are the people who are saving regularly, and you need to intervene. And just in short, yes, we did a lot of interventions in terms of rewards, in terms of co-contribution, and we have seen different experience coming in. And again, it was based on age, gender, the channel, whether it was through a microfinance institution or through a civil society.
Thanks, Aindev. I think there's one thing that is stuck out of what you just mentioned is on culture. And that brings me to you, Amlan. I mean, Greta and they've just spoke more about the micros, more about the infrastructure, behavioral side, what is needed for people to save. But I remember having discussions with you on, the macroeconomics of savings. Can you tie this, you usually talk to the richest of the countries, and in the richest of the countries you're trying to target the lower income group in those countries, but here are these experts on this panel, and I'll come to David shortly, who are working in countries who are low income groups. So are there synergies? Is there like a behavioral theory of savings? Amlan, you're on mute.
If I can get this. Okay. Thanks a lot. Sorry for missing a little bit of Greta's contribution. Unfortunately, technology, even in an advanced country like UK, can let you down if you're living in very old constructed homes. So apologies. It's a pleasure to be on this program. Unlike most others on this panel, I'm not that much on the ground. However, I would like to correct Parul to say that at State Street, we work with the biggest institutional investors in Latin America. So we have Peru, Costa Rica, South Africa, we have things with Cote d'Ivoire, as well as Bangladesh. So it's not true as the third largest asset manager, if you're holding every company in the world, that you don't deal with them. But clearly the bigger focus is there. I'll wear three hats. First, my hat as a crisis researcher. I started looking at crises in 1981 in India, working on the World Bank IMF project on conditionality during the Latin American crisis. End of January this year, I made three statements. This crisis, contrary to the Western world, challenging probably most of World Bank, IMF, ADB, this crisis will be worse than the Great Depression. It will be worse than any other pandemic because we are in a globally integrated world. This crisis has shuttered in, consumer shut in of 8 billion consumers. Please note, across 200 plus countries, no other crisis has done this. It has also shuttered in 4.6 billion organized workers like me with no hope of going into my office until February or March, thanks to regulatory and corporate pressures. So companies are trying. And thirdly, this is a health-oriented crisis. What it is laying bare, most of all, is one word that I'm passionate about, which is inequality. I've been working on millennial development goals and sustainable development goals with the World Bank for a long time. And it's a great pleasure to quote Maitrey Bordia of the World Bank, who's written a very, very nice blog for the World Bank. She's head of social protection, etc. The human face of COVID-19, 6 things to consider for an inclusive recovery. And the basic thing she talks about, and this is very much in line with I and Dave, is that first of all, let's try to acknowledge the long-standing inequalities, exclusion, data limitations, tools, and then try to understand the private-public partnerships. My second goal is to talk as a macro researcher. As a macro researcher, savings, GDP of a country is the whole spoils. And everything made from a pin to an aeroplane and services are all included in GDP. You take out of that taxes at a human being's level or at a household's level, if you're paying taxes and if you're at the level of paying taxes, it's disposable income. And disposable income gets split into consumption and savings. Savings typically has been important, but I would like to tilt your focus. Everyone on your panel largely is talking about developing countries. I am passionate about developing countries. End of January, I said, developing countries are likely to lose a decade in this crisis. And I was a consultant to IMF, World Bank, Treasury, 36 EM central banks during the Asian crisis. And I worked at Credit Suisse along with IMF, creating those kind of models. Why did I say that it's going to be worse? Because the informal sector gets ignored. And while disposable income growth is going down, people aren't cutting their consumption in the rich countries, and savings also is going down. If you give me a second, I will see if I can share a screen with you on how, not just in the rich countries, I hope I can pull this up and you can see this. Let's see. I don't know, can people see this?
We can see that, Amlan.
You can?
Yeah.
So this basically shows you savings of the world. And if you look at savings rates of the world,
Amlan, the screen is
on this next slide, not very big. I am sad that again, this slide, yeah, you can see this probably better. You can see gross national savings as a percentage of GDP going up for one country dramatically called China, but in rest of the countries, it's kind of going down. So my argument is savings all over the world are not growing, and they are not being helped by the fact that inequality is growing across the world. And in this crisis, inequality has served very poorly women. The gender inequality gap has grown tremendously. The extent of gender equality is 160.2 trillion on human capital in the world. And I wrote a paper where I said, if we reduce gender inequality in any country, it's grown in UK, more jobs have been lost by women, in US, in Canada, in India, in China, everywhere more women have lost out relative to males. And if you reduce gender inequality, it's better for growth, it's better for debt, it's better for sustainability, and it's better to reduce overall inequality. So I do think savings is a must, not just in poor countries, but also in rich countries for one simple reason. People are living longer, and the demographics tells you, if you want to plan for longer, there isn't a single person who can answer this question. If I retire at 60 today and I were to live until 85, how much money do I need? So given the uncertainty in this world, people need to save not just for today, but also for the longer term. I'm a big fan of pinBox, and what people like I and Dave are doing is something has been practiced in China. They've tried to bring together savings, insurance, as well as the long-term savings motive very closely by bringing in behavioral theories. And on that note, I'll leave it to you for further questions.
You've actually given me a very good leeway here. Thank you so much, Dr. Roy, for that. But given this whole macro picture and the vulnerability of women given this pandemic, Dr. Tusta, if I may come to you now. Now, as a global pension expert, and Amlan also touched upon long-term savings, and a formal finance minister, do you think both the pension sector and the policy perspective, there is savings is key for both short-term and long-term? And it's very evident that the problem is there. It's stark whether people need to save for their immediate needs, which we Amlan touched upon as well, that unless you don't take care of their interim needs, which we'll come to later, long-term savings is not going to happen. But yet the question of pensions for all, because this is a huge problem in 20 to 30 years time. If we don't solve for it today, it will be another another huge crisis that we cannot meet at that time. So why is pensions for all not a burning issue now?
Thank you, Parul. Thank you very much for the invitation. And yes, your question is very simple, but the answer is very complex. This is I don't know, this is something that different think tanks and international financial organizations are studying for a long time, trying to see how to solve this issue, how to face the risk that people would face in different stages of their working lives, and particularly the retirement stage. So what can we say? Emerging economy shares many common characteristics that prevent that any formal institution works. Okay, so pension system is one of these formal institutions that we wanted to work. Okay, and the idea of pension that most of us has in mind surged as a, how can I say, as a social innovation, where firms and our governments and our workers were obliged to contribute for pensions. So it is important to remember the context of introduction of pensions, this social innovation, this Bismarckian innovation, because it was basically a social mechanism to improve social conditions to an increasing urban population in the context of the progress of previous industrial revolution. Now we are currently in a new industrial revolution or a digital revolution. I don't know how to name it. So in the beginning, including in the case of emerging economies with no large urbanization, pensions started working in a very limited scale at the beginning, basically for a reduced number of public servers and probably some particular industries. But when emerging economies start with developing, in contrast with developed economies, the transition from rural society to predominantly urban framework surpasses the limited capacity of their formal institutions or pension systems, and other institutional arrangements like taxation, for instance, could not work properly. So the fast transition from rural to a disorderly growth of urban spaces bring about a problem of informal economies. And in high informal economies, like in Latin America, that encompasses also the problem of low-income country, high level of poverty, inequality, and non-solved institutional problems makes impossible to successfully enforce any mandatory schemes. Tackles the problem of high financial vulnerability, and particularly in the period of retirement. So what we have in the majority of emerging economies, and particularly Latin America, is the presence of a huge informal economy. Around 50% of the workforce is in the formal sector, and we have some very extreme cases as Peru, for instance, that 70% of the workforce is in the informal economy. Yeah. And if we take into consideration all likely constraints that deter the possibility to continue to contribute, I mentioned before, no, low income, poverty, lack of incentives that were mentioned before. Well, it makes it really difficult, no, to design a framework or a product that can be offered to successfully to the economies. And we have to take something into account. You know that during that this last around 2 or 3 decades of increasing prosperity in emerging economies, we have massively introduced a solution. No, that solution was the introduction of non-contributory pensions. You know, many countries have introduced that as a way to solve this issue. But although this approach is important, particularly to those most vulnerable, and that this approach could also bring relevant positive externalities, that the use of the banking system, financial literacy, poverty reduction, women empowerment, etc. I think that we can agree that this is impossible, that this approach could be a sustainable approach if they are not carefully managed. We have many problems there, no? For example, which is the level of the non-contributory pension that we want to offer? Which is the population who we want to cover? Are we going to provide a universal solution or probably a focused solution? How do you adjust this contributory pension? And what if you have the fiscal budget to do that? If this is something that could create a disincentive to some former workers to stop contributing or saving, and because they now have this solidarity pension by granted. So you have many problems there that makes this issue really complicated. So in a nutshell, I can say that informality is the main factor that deters traditional pension systems to work, and non-contributory schemes is not the solution to the problem, and we need new social innovations, no, to solve the social protection risk that I can say is still pending.
I actually agree with you on a certain points, and I'll delve into what in the next section that we take on what is it really just the role of the government to do that, or even can the private sector pitch in to make this to resolve for this? Because Amlan, did you want to come in here? I can see you nod.
Yeah, I wanted to, and I think as a pensions researcher who travels probably 70, 80 countries at least, in the last 4 or 5 years. My basic impression speaking to regulators and learning from people who originated pensions for US like 401ks, etc., is no single solution works well. So this is a message that I give to Denmark, Norway, Netherlands, Australia, the largest of and Canadians, because their models were based on a roadmap of the 60s, 70s, 80s. Today, we need multi-pillared solutions, something for which World Bank deserves a lot of credit. It's got to be the individual, it's got to be the family, it's got to be the community, it's got to be the corporates, and it needs to be better targeted. Defined contribution is not a solution, Modigliani said on his deathbed. Neither is defined benefit. Good implementation is key, and that's why countries on gender inequality as well as on microfinance, some of the countries which do well are countries you work in, and Iron Dave, Rwanda is fourth on gender inequality, US is 51. And you have to explain, I claim, and honestly, I've said this at ADB, World Bank, with World Bank president as well as others in the audience, US is the most health inefficient system in the world, and Singapore is the most health efficient system in the world. Somewhere between $1,000 per person and $17,000 per person, you have to square the thing. But that's rich countries. Even in poor countries, Chile is a great model. And that's why I have a little bit of disagreement with Dr. David Tuesta. As an academic, I'm in his camp. But from a practitioner viewpoint, even in Europe, you find that the Nordic countries are different on pensions. The oldest countries, I wrote a paper we presented to the Japanese Prime Minister. Japan, Germany, Sweden, Greece, and Italy, the 5 oldest countries in the world, are absolutely planets apart in terms of their pensions provision. And we need to understand why. Institutions matter, consumption matters, education matters, health matters, and all these things. David knows that Peru and Chile and Mexico and Brazil are different, but we need to understand those differences. I call them heterogeneity. And people in Europe don't like it when I say EU 28 is 28 shades of gray.
Yeah, I thank you for that, Amlan. And I think I'm going to shift gears a bit to on gender, and just focus on ask you something, Greta. So recently we had Melinda Gates sort of release this video, I think 2 days ago, when she spoke about how this pandemic has left women even more vulnerable to economic shocks. Now women are not going out in the out to work so much because they now have a family to look at in this lockdown situation. They've lost their jobs, they have family responsibilities. Now there have been income disruptions obviously, but there is this short-term G2P transfers that we are seeing, but they can only take us that far. Then what? So how is and then there is this huge infrastructure that is created by the financial inclusion network, which is seeing a huge jump in this digital channels and platforms of information, communication, payments, and finance. So, do you think there is this dramatic growth in technology adoption and digital behavior? Will this be permanent, or will this digital movement continue once the pandemic is behind us? How do you see this?
That's a really big question, Parul. If I could just maybe pop in a couple of ideas based on the conversation that we just had, specific on pensions, because I think, first thought is, crisis shakes us up, but crisis also allows us to move forward, right? And so I think there is a lot of opportunity in this crisis to move forward. As I was listening to you speak, one of you, I can't even remember which one of you it was, I was fascinated by what everybody was saying. Let's remember that the Social Security Act was passed in 1935 as a response to the Great Depression, right? And we might have disagreements with how effective Social Security is, but I think these kinds of crises open up opportunities, right? And so I think as we think about the digital future and the infrastructure that's been built, we should bear that in mind. I also think one thing that's a little bit missing for me in the conversation about pensions is I think we need to think about what the long-term objective is, which is building resilience for people over a long period of time. So it's broader than just a pension, right? So asset accumulation and housing in particular, I think is something in a lot of developed countries where people actually use that as their, almost as their sort of pension as they get older. And so I think we ought to think about this more broadly. And I think that's a place where the private sector might be able to come in, but we can get to that topic later. On your question about, the digital infrastructure and is that going to be with us? I mean, I think COVID has certainly demonstrated to policymakers the importance of having the infrastructure in place to be able to make payments quickly to accounts. And we've seen pretty massive mobilization of those accounts. I think India is sort of, the most visible case, but we've seen this in a lot of other countries as well, right? So in India, over a pretty short period of time, large numbers of very small payments were made to low-income households during the initial months of this crisis, precisely because the Indian government had invested in identification, bank accounts, payments architecture, all of that was in place. And so, the Indian government was able to get money out to people. I mean, contrast that with the US, where some of that was in place and we just couldn't get ourselves very well organized. But, I think India is a pretty strong proof point for the value of investing in this public infrastructure. I think Peru also sort of rises to that. We've seen a lot of countries that have really been able to leverage those investments that they've made to get money into people's hands. We've also seen where the gaps are, and I think countries that have fallen behind, I mean, there are a few countries that are delivering social payments to people out of the back of trucks, right? Mm-hmm. And so I think, there's been a boost to people seeing the importance of that infrastructure now. I think the acid test for durability of this is going to be whether we can layer on more use cases above and beyond social protection use cases, right? Because we're going to start, I think, as we come out of this pandemic, seeing those taper off. And then, if we want people to keep making use of those accounts, once the worst of the pandemic is past, I think we will need to see a compelling reason for people to use them, right? So I think in some places we will see a permanent shift to digital adoption. We're already seeing that, certainly in the developed world. You've seen all the tech companies, seeing much increased flows of digital payments, et cetera. I'd expect to see the floor kind of rocketed higher in places like Kenya, Ghana, India, South Africa, where there's already strong digital. Sorry, did you want to come in?
No, please go ahead.
Oh, okay. So I think in other markets, the experience will be less smooth. And so it's going to be hard to tell if people will stay with digital means or might prefer to revert back to cash. I think a lot's going to depend on the value proposition that's available for people. So certainly for things like government to person payments and increasingly also person to government payments, so tax payments and services payments coming in, we're seeing an acceleration of trends. Bill pay has long been a really useful use case, right? So bill pay, if you look at the GSMA statistics, it's sort of constantly crept up as a use case that people have been happy to use. I think the tough one is merchant payments, which for a lot of reasons have been a lot slower to take off, not least in Africa because of the quirks of how mobile money agents get paid, right? And that's actually where the real volumes are and the habitual use. So if people start moving into using, a card or a phone or whatever form factor you have for merchant payments, then everybody starts being very digital. And you have only to look at places like Sweden that are kind of worried about cash disappearing to see where that takes us. So I would keep an eye on development of merchant payments. I think that works in places where people have bank accounts, where they have smartphones. We're seeing QR codes becoming more dominant in a lot of places. And so in those places, I would expect to see some acceleration of digital payments. I think in others where that infrastructure is not in place, it may be a slower curve.
I agree with you on creating this environment for the payment structure, and I think I'll come to another question back to you right after I address Ayandev, is on what are these payments actually being made for? Is it for current consumption? Is it to pay back loans, or is it to actually make the savings? Now, you also made a very important point, Greta, on after the pandemic, you need to also have the use of the infrastructure that is now being created. People are using digital because of the lockdown; they didn't have a choice. But can we create a habit right now for people to start using this even beyond the pandemic? So, Ayandev, I remember having this discussion with you, which we lightly touched upon before, and I know Amlan did as well, is there a use case to have, pensions, savings, not necessarily in that order, and insurance being clubbed together? Is there a case for social protection? How is it that you take care? And we say this even in our experience that we work in pinBox, is that you have to take care of the interim needs of people before you can go forward. You spoke about livelihood, you spoke about climate that affecting women. So how is this, does insurance have a part to play in all this savings part, and how do you see this happening, including in what is happening in Rwanda? We'd love for you to share that as well.
Okay, thanks, Parul. And yes, as you rightly mentioned, I thought not only COVID, even before COVID, women are increasingly being more vulnerable than men when it comes to the impact of climate change. And one of the most important reasons, if you look at agricultural workforce and most of the agricultural practices in Asia and Africa, it's predominantly exposed to the natural resources, natural calamities. And that is what makes more sense, that it is not only COVID, but in general, we need to look at this equality and also see how we can create products which is more of gender specific and more of responsible in terms of gender. Now, coming to your question, Parul, on looking at integration of saving, insurance, as well as looking into the component of pension, which is more importantly. Yes, it has to be that way. There is a lot of merit in having an integration. So since I'm in Rwanda, let me share a little bit of the Rwandan story. And Parul, as you remember, when you look into the saving, it's, as I said, it's a behavior, it's a culture. So and I also agree with Dr. Amlan, as you said, that you can't just take this model from one country and just put it into another country. It has to be customized to a large extent. And it has to address all of these, be it the barriers, whatever barriers we see, social barriers, systematic barriers, infrastructure barriers. So, and if you remember, the Rwanda journey started, and thanks to pinBox, they came with a feasibility study, and they tried to look into various components in terms of barriers. And then we designed a solution which addressed some of these barriers. Now, coming to it and coming to the solution which was designed, and the Ministry of Finance, where I sit now, plays a very important role in the design and implementation of the scheme. So it was not left to the private sector, but the government played a very important role in deciding on what sort of technology, what sort of infrastructure, what sort of implementation architecture that needs to be created. And in December 2018, the Rwanda government launched a long-term savings scheme, which is called as EZO scheme. But the most important component in that scheme is the insurance. It is not only a long-term savings scheme, but it also has an insurance as a benefit. And one of the reason why, and somewhere in the chat there was a question, and I'm just trying to answer it as well. You see, the informal sector is not only the risk of longevity, but they also have a significant risk of the mortality, and mostly to do with the occupation, mostly the place where they live, their lifestyle. All this actually leads to a lot of mortality risk. And any type of shock, which I was just at the beginning, as I said, Parul, when you look at why people are not able to save, forget the access and affordability. The another important thing comes is when I save enough, all of a sudden there is a shock in the family and the money gets absorbed. So the objective for which they saved the money was not used for that particular purpose. So it was important to bring these two components together so that you not only address the longevity risk of living too long, but you also address the risk which is dying early, And to do this component, which is an important thing that in Rwanda we did, and which address a lot of gender equality, which address a lot of challenges at the infrastructure level, is to bring in the technology. And what we did is we have today a NID-linked digital pension platform. And what it solves, if you ask me, it solves and it makes the schemes portable. So it doesn't depend in which part of Rwanda I am. It doesn't depend that I need to visit, So when mostly when I used to ask people why you don't go and save, they used to say, the farmers or the informal sector people, I lose my one-day job to go to that access point where I can go and contribute. Now what is this technology platform is solving, and linking with the national ID. And as I said, and it is also important to think right from the design stage. So as I said, it has to be customized, So that is what it is, Yeah.
I think that's very interesting where Rwanda has been able to club savings with an insurance component, a funeral insurance and life, I think. And also
Yes.
there's a co-contribution from the government.
Yes.
But if I can just shift gears a little bit here and come to you, Amdan. Why is it important to save? Why do people need to save in the first place? How does it really link to, the effect of savings and GDP? How does this come together?
So I want to go back to, I hope I'm audible.
Yes, you
Parul,
are.
am I audible? Okay.
Yeah.
I want to go back to the basics. Let's go back to Adam Smith or primitive economies, etc. I have a certain amount of crop, going back to Ayandev or Greta or David's example. I choose to eat some of it. I choose to save some of it to eat tomorrow or day after it. This is called intertemporal allocation of resources. Could be water, could be food, could be commodities, could be anything. So people save, deciding not to consume today, postpone saving. That's one motive for saving. That's called intertemporal. What comes in out there are two behavioral aspects. One is how risk averse I am. You and I might have the same crop, but you think you want to put aside more for another period than consume it today. I think I'm not going to live that much, so I consume. So one is called risk aversion, another is called degree of impatience. I want to consume today because a bird in hand is worth two in the bush. That behavior itself is intertemporal. It's not today. And I claim no country in the world is saving enough. We wrote a very, very critical, very, very caustic report to the UK government, which then I applied to every other rich government, called Age of Responsibility. It says we aren't saving enough and governments are not influencing behavior enough. And this goes back to two very important books I'm going to recommend you absolutely must read. One is called Nudge. It's been used in 17 countries to influence retirement savings behavior. Evidence on that is mixed because behavior, as Ayandev, Greta, and David know better than me, doesn't happen overnight. But you need, as David said, today's world is very different than 30 years ago, where you told something, people listen. Today you have social media, family, etc. So not just Taylor's book with mixed results that, yes, behavior can be changed if you get rid of certain biases. We all have certain biases, whether it's bias for status quo, herd behavior, etc., etc. How you frame the question matters. So in experiments we've done at the University of Iowa, one of the leading experimental schools, People vote differently for different election candidates depending on how you frame the questions. So that's how you can change. There's an even better book which says start teaching people at 3 to 4 how to save. It's called Save the Acorns, and it's written by a good friend of mine, Robert Gardner, who set up one of the biggest pensions consultancies in London. And he shows how children, if you teach them to save earlier on, they learn more. Now, if I were to ask and shame most people, which is the most financially literate country in the world? And the answer to that, based on average, hands down, is a country called Denmark. Why? Because they learn about Danish mortgages at age 11. The best interest rate models in Chicago, in MIT, in Harvard, Stanford have been built by Torbenson, Nielsen, Hansen, and Halvorsen. All Danes. It's not a coincidence, an average person. So we need to educate people better. And education doesn't mean formal education. It means communication, could be through TV, could be through social media, and things that Greta's organization are involved in. A lot of it has to do with communication. The Fed chairman is changing his communication. Christine Lagarde is, so is the biggest microfinance organization in Bangladesh. They said what worked 20 years ago is not what is working as well today. So communication is very important. And savings happens lastly for two things. One is for not consuming today for later. Another is the precautionary motive. And let me tell you something which shocked the whole world. Savings ratios went up to 35 to 45% in US, Japan, Germany, and UK during this crisis. When the government gave them money, the poor people just said, okay, we are sitting at home, we are not working, we are getting this money, but let's save it for another day. The country which is a hero in my eyes is a country called China. And no one talks about China because the Western world and we in India don't want to talk about it. In 2002, speaking to the Chinese Prime Minister and 600 insurance leaders out there, what I said, I couldn't have implemented better than the way China has implemented. And the way they look at insurance to Iron Dave is exactly going to agriculture, going to manufacturing, and then going to services, going to the most vulnerable first to show them it's not what we economists call, and David knows this better than I do, we call it life cycle savings, but I would say lifetime savings changes over a horizon of 0 to 95, with the older Japanese at age 70, 75, 80 still saving because they don't know how much money they'll need at 90.
Yeah.
That's the education we need to give people in Rwanda, India, South Africa, Venezuela, etc. Thanks for that.
Thanks, Amlan. In fact, this is also a question that Ashim Joy had brought up, and so did Anil. I hope it answers that. But I'd like to bring you here, David. So Amlan said something very interesting. And he said that savings and, I mean, the pattern from 0 to 95 is not going to be the same. And I think the pandemic has proved this on savings as well, because now countries are given early access to retirement savings and has somewhat eased the economic shock of the pandemic for salaried workers. But non-salaried informal workers have no benefits of such interventions, and they are excluded from formal pensions, formal protection arrangements. Let me not say pension all the time, but to Greta's point, but this social protection arrangements. So what do you think is a long-term impact of this premature pension withdrawals? Because not only will the formal sector be affected, but also the informal sector will be affected, because not the formal sector will have lesser money as they grow older, to Amlan's point, and the poor people are anyway not covered, and to Iron Dev's point, as livelihood needs to be increased, but conflictingly, Amlan is also saying that people are saving more. So how do we make, what do we make of these premature retirement benefits?
No need to save more, Parul. They need to save more. They are not saving more.
Sure. David?
Yeah, sure. Taking into account also this remark of Dr. Amlan Roy, that's right, that's right. And yes, many questions, Parul, many questions. So
I think we'll pick the one for the withdrawals from the formal sector has been allowed to do, and what impact will that have in the long run on economies and individuals. We'll stick to that.
Well, yes. The first point is if this is a good or not is a good idea. I can say that it depends. Beyond the idea that everybody needs to save more, that's okay, but it depends. We need to consider the context that we are currently facing. So first of all, there is a very recent interesting literature that argues that having a very strict savings account with a unique long-term view could be inefficient. Okay, focusing on pensions. Okay, this perspective says that to only focus on the retirement shock and leave and cover other and multiple financial shocks that a person could face during this active working period is not a good idea. So depending on the level of contribution rate and under some conditions, it could be plausible to define ex ante situations to access to the pension pot. Now, this is a first issue that I want to underscore. So again, to have access to some liquidity could be relevant in some cases. And in fact, some systems around the world provide ex ante rules, okay, to early withdrawals to pension funds. For, I don't know, buying a house, you can access to a percentage of that because the policymaker thinks that this is something good for people, okay, or for healthy reasons or any kind of shocks. In some cases, for instance, they include a clause to refund the money, okay, in order to get a pension in the future, okay. I think, for instance, that this clause it's okay, but you have different options, no. But beyond these issues that we imagine some normal shocks that you can experience during your working period. There are very dramatic shocks that COVID-19 that was clearly a very exceptional situation, and depending on each particular country, it made all the sense that some governments allow early access. For instance, no, in cases where there were not any other financial support, it makes sense to allow the early access to a small percentage, probably. Okay, this I think I want to also to highlight the cases that I know pretty well, that are the cases of Chile and Peru. Okay, which has a mandatory individual mandatory scheme, which is part of the social security. This is something singular. This is not a voluntary scheme. This is a mandatory scheme. This is the main pillar of their social security. Okay, and were not considered in the to access to early withdrawal. But in these exceptional times, in the case of Peru and Chile, the government allowed the workers to retire 10% of the fund in the case of Chile and 25% in the case of Peru. That was a lot from my point of view. And just making some estimates, it could affect, I can say, around 10 to 15 percentage point of the replacement rate. Okay, the estimated replacement. I mean, more or less, in Peru and in Chile, people save around 10% of the salary, okay, during their working life. So considering the frequency they save, this is estimated that you can get a replacement rate of around 40-50% of your last salary. So you can diminish 15 percentage points as a consequence of this measure. But the problem is that, this measure, this initiative that to provide access to a lot of money for people at that moment is very popular, and the problem is that your politicians, okay? And now, for instance, in Peru, it's under discussion another initiative, okay, for early withdrawal of around $5,000, okay, as a limit that represents 80 times the minimum salary, and people is very happy with the measure, but at the end, what is going to happen is that comparing to the 25% of assets under management that the pension fund have before COVID-19, as a consequence of these measures, you are going to have only 15% of GDP of assets under management. So,
wow. Yeah.
So you think that you solve a problem now, but you are increasing your vulnerabilities, okay, in the future. So I think that is very important to think about it. And again, I want to highlight that we need to develop another social innovations in order to face this challenge that is going to be huge as a consequence of this kind of decisions.
Okay. Thank you so much for that. I agree it's a tough question. Chile has been able to somewhat have mandatory pensions as well. I'm glad they've allowed withdrawal. I think the jury is still out there in terms of what the impact would be given 10 years or 20 years out. If I can just shift gears to a few reactions from all of you. So I'll circulate the question to you all and make it like a little bit of a rapid fire, so to keep it more exciting. So I have this always in my mind, and Greta, we touched upon it a little before, is on the what are the payments really made for? So the microcredit has had a powerful impact on livelihoods, incomes, economic empowerment, but especially for the low income self-employed women. But has easy access to credit also adversely impacted how they save or savings behavior? Do you think there is some credit there? Is this something that we need to sort of ponder upon? Greta, I'll start with you.
Yeah, that's a really interesting question. And, I'll talk about this in the context of where I know kind of digital credit best, which is sub-Saharan Africa, where it's spread pretty rapidly now that people can get loans almost instantly on their mobile phones. And I talked a little bit about M-Shwari before, and the yin and yang of the M-Shwari program was that people would save so that they could get access to short-term credit, right? And so it was actually sort of a full banking product for low-income people, right? You get your savings, you get your loans. We're seeing a proliferation of just short-term consumer credit being offered over, and it's actually kind of remarkable how fast it's grown. I did some work on this in Zambia a couple of years ago, and it's just off the charts growth of digital credit. So the way I think about digital credit, at least as it's being offered right now, is fundamentally as a liquidity management tool, right? Short term, easy to get, very expensive. You have to pay it off within a month. It actually mimics a credit card in a lot of ways. And so I think, what we do know about the way poor people save is that it goes up and down, right? I think it is hard to find a lot of good examples in very low income countries of where people in the informal sector are saving long-term for pensions. They use other tools for that, right? And so balances go up and down. And now with digital credit, balances go up and down, sort of below the zero line, right? So it's really a liquidity management tool. And I think, obvious health warning, these kinds of tools are dangerous. Credit cards are very dangerous in the US as well, but they're also a really important resilience tool so that if I hit trouble, I can, run a balance on my credit card and sort of gradually pay that off over time. So I don't think we should dismiss it entirely as a useful tool, but it's dangerous, right? And what I'd like to see is a lot more building up of other tools for low-income people. So I think over the last 10, 20 years, we've seen, microcredits come along over a longer period of time. That's kind of productive credit aimed at informal sector. Then we saw payments come in and really sort of explode the inclusive finance sector. And that's been really important. And I think the evidence base is strong that payments do provide a safety net in a lot of ways, not just social programs, but being able to draw on networks of family that are further away, for example, family and friends. And so I think payments have been really an important tool. Then we've seen sort of this digital credit boom. What we're not seeing so much is really robust models aimed at the bottom of the pyramid for insurance, for pensions, for savings. And it's because the business case is harder. And they're usually kind of the yin and yang of some of the credit models to make stack up, right? And so I think we have to look at these things in the round and keep building up those tools. I think, the fintech boom is bringing some models out, and we have to see how they do. But I think there's still a lot of work to be done. And I think, in particular in the microfinance space, I think there's a lot of work we need to do to move the microfinance industry forward. And it's hard to talk about the microfinance industry because it ranges from really sophisticated institutions to very basic ones, right? And so it's not one set of institutions. But I think for the most part, we have not seen enough evolution in those microfinance institutions where they're a little bit more agile, a little bit more nimble, a little bit more digital, with much more robust kind of back office capabilities, so they can offer the kinds of products to low income people that they need. For example, housing microfinance, they just don't have the capabilities to do that in a lot of cases. So I think Peru is a really good example of a great microfinance sector that does a lot of good, but we don't see that in the rest of the world. And so I think there's still a lot of work to be done to make sure that these kinds of institutions that are there to work for low-income people are able to provide not just a little service here, a little service there, but a broader range of services. And I think that's a journey that the sector's been on, and we still have a lot of work to go.
Okay, thank you. And then quickly, is access to credit, given that you're in Africa right now working a lot, is it just too easy? Is it making people lethargic to save?
And not really. You see, as I said, when you come to saving, only once you have income. And currently, when this credit is coming, it is actually helping them to earn more. You know, today, if you see the agricultural productivity, we are on one hand, we are also speaking of food security and agricultural productivity. This all depends on agriculture finance, right? So today, if we just stop this, there will be no room for saving, right? So I completely believe that there has to be more of agriculture credit. But what I also believe, Parul, is today there is an importance of strengthening the linkages between the social protection programs. That is quite important. And it needs to ensure a complementary approach. Sometimes what happens is I'm giving subsidy, I'm doing cash transfer, but I'm leaving maybe the saving component, right? Maybe I'm leaving the insurance component. So one is to look into the de-risking of the overall sector and also to have the linkages of all the social protection programs together.
Fair enough. Amlan, before I come to you on how savings also lead to investments, but I'm just going to direct one quick question to David. David, we've had several discussions and also working towards in Latin America on this bundled offering for the informal sector workers for short-term savings and long-term savings. I wanted to know what is there a hunger for this? Is this something that the private sector and the governments are looking at as a solution before, to help people save?
Sure. I think so. I think that previous to COVID-19, there were very interesting initiatives. Okay, not formal established in any pension or saving system properly saved, but very good, interesting initiative from private fintechs, pension techs, international financial institutions like the Inter-American Bank of Development, which are, for instance, incentivizing the participation of governments and some regulators in many pilot programs. Okay, so one interesting example is the initiative of the Mexican regulator, CONSAR, which in collaboration with other fintechs implemented what is called millas para el retiro, something like miles through retirement, that allow to save a percentage of people's consumptions by using an app. So I think it's very interesting. The engagement has been very inspiring, but the amount was expected are more symbolic, but it's a good way to explore solutions for informality. The other interesting pilot is the case of the IDB, that they implemented 15 pilots in 15 countries with using the platform of Uber and Cabify, incentivizing taxi drivers to voluntarily save for pension, also with interesting result. And I think that COVID-19 has brought many problems, but I think a good opportunity, okay, in order to think about more about how to solve this problem of people who are not saving enough, particularly in the case of pension. So how to incentivize people and implement a social protection approach that makes sense in an informal scenario? I think we need to establish a public-private approach. I think this is something that is currently experienced in the region, that allows the creation of savings, and this issue that Anjad also mentioned, that we usually not think in insurance, and insurance is key here in order to provide a broad product, in order to face different risks. So you need to this public-private collaboration. First, the government facilitates the use of technology and that makes parts, for instance, in the key development of digital IDs, for instance, the introduction of technological platform or solution that reduces transaction costs from the supply and the demand side in order that saving insurance products be offered and consumed. This would be, I think, necessary, in order to design also frameworks that support financial education, the necessity to use digital payments as a connection with different social aggregators, with the informal sector or the microfinance world. Also, I think the necessity to provide an integral financial product that simplifies informal worker decisions, no? The combination of savings, liquidity, and insurance. I think that this is, you need to offer this integral solution. Also, the use of solution for behavioral economics, I think that this is also important. And if it's possible, the introduction of some financial incentives as matching contribution, if budget, fiscal budget, allowed to do that, but yes, I think that we need a broad concept in order to tackle this problem.
In fact, it's quite fascinating. This is one example in Kenya where Zamara, whom we work with, have actually worked on with a liquid product along with the last right insurance, which is actually picked up so well, where they brought out the need of the people after a lot of data behavioral science. I'm happy to share that with you, David and the panelists, that has come through. So I think that is one example that is done very well. Amlan, coming to, now we're talking a lot about savings, but there is also this demand, savings need to meet investments. So how can we take it on from there? How do you provide adequately?
I think we've been putting, I'm sorry to be blunt, we've been putting the cart in front of the horse. People save and they expect their savings to get translated into future income, into greater income at interest rates. And here I speak as a finance professor, and I'm sorry for saying this, but asset allocation of investments for pensions is very, very, very important. And I will pick up on what David said. In the year 2000, I presented at CONSAR's annual conference to the Afores. And I said, Chile is not the right role model for all of Latin America. Why? Because the consumers in Chile are different. The workers in Chile are different. The education level is different. The health is different. And the institutions are different. Retirement ages are different. We really need to construct newer incentives. I said this also in Brazil while opening their pensions conference, right with their finance minister in 2015, saying that, see, Mexico is now trying to agree on the fact that the Chilean model they adopted is not right. But let's go back to investments. When people save, you want your savings to grow. Who lets those savings go? Their banks, their capital markets, and all of emerging markets now face a very, very big need to build resilient capital markets, because that will enable them to keep the shocks that David talked about away. So a COVID shock coming from developed countries shouldn't affect Malaysia or Chile or Peru, and resilient capital markets we need. And we need to develop a savings habit for that, saying that if you save more, then with good amount of savings, we can also entice and create good investment mechanisms and tools. So I just gave a Latin America thing. I'm going to give 4 quick snapshots in just 40 seconds of retirement lessons over the last 20 years on asset allocation, because that we've been talking about digital and reaching people, but if savings doesn't grow, then investments are to blame. Number one, Japan started off in 2000 with 96% pensions assets to GDP. Today they are at 64%. Netherlands went from 95 to 170. Why? Because Netherlands did not invest in their own country. The Japanese invested in their own country and lost 3 decades in JGBs as well as others. This has been my message to Chile, Mexico, Peru, as well as to the FLAR, which David would know is a retirement Andean system. The third thing is World Bank deserves the utmost credit for talking about something David talked about and they've talked about, Greta talked about, the fact that we need public-private partnerships and we need multi-pillar solutions. So it needs to be savings across a spectrum, savings for me to get food, savings for my children's education. The objectives of savings are different. And now we are seeing, even in US, oldest people are saving a lot to buy houses for young people who can't buy. So there's a multi-generational issue of savings, retirement, and capital markets, of risk sharing for 20-year-olds versus 90-year-olds, which is facing the most sophisticated pension systems in Netherlands. And that is very important. I close with a big tribute to David Malpass, the World Bank president, who said that public sector has done tremendously for this COVID crisis, but private sector has lagged behind in providing debt relief in micros, small, medium enterprise finance, etc. So the call is we cannot look at an era of COVID where all the big money goes to the big players and the private sector stands back and gets rich at the expense of the poorer people in poor countries, also poorer people in the rich countries. And that's, I think, important. Savings and investment are two sides of the same coin. It's not that one leads to the other. And if savings is different than investment, one of the leading economists at St. Louis Fed argued, and I've written papers along with New York Fed to prove it, savings investment gaps leads to capital flows and current account deficits. So to understand capital flows and current account, you have to understand savings investment in India could be different than Pakistan, in Peru could be different than Chile, and so on and so forth.
Thanks, Amlan. We're almost out of time, but I just have, before I take the last comments, I also just wanted to welcome Mr. Aminu Farooq, who is the regulator of pensions in Nigeria. And he's asked a question on, we are mostly silent about financial health and financial inclusion. In most developing countries, savings could be a privilege as many could not afford it. How do we tie the need to save for pensions and the ability to save by the informal sector? Ayandev.
I think, you see, the need as well as the ability to save, as I already mentioned, the ability to save has a lot to do with the income, income ability. But apart from this, Parul, I think there's a huge role that the government, the regulator, the civil society needs to play in creating awareness about the need of financial products. And I'll just give you a simple example from the street of Rwanda. Rwanda went for a lockdown like any other countries. It was a complete lockdown for almost a month, and then there was a partial lockdown. We are under still some restricted lockdown. Now, when I speak to a cab driver, when I speak to a motor driver is like a bike driver, and when I ask them what sort of risk that they foresee now, and it is the risk of lockdown. Now, for them, it doesn't matter whether GDP is going down, whether it is economy is moving to recession. For them, the risk is next lockdown. And they believe if there is a next lockdown, it is significantly going to impact them. And now what is happening is, if you now tell them about emergency fund, emergency saving for emergency, it is very easily they can understand it and they can start saving for it. So in fact, my question to them was similar, Parul. I was asking them, now you're saving. So they said, yes, I'm putting X amount of money aside because I don't know tomorrow, maybe another lockdown. So I think, and now they want to hear it from someone. So when you hear lockdown, it's coming from the government. So government is mentioning about the importance of this lockdown. It's also mentioning about the risk associated with it. So now they're able to link it with. So I think as long as the awareness and the need is always there, but the ability, as I said, one is the income. You see, it's more going back to the economics. You have an effective demand, you have a demand. So effective demand is both willingness as well as the ability to pay. So one is the income, as I mentioned, but the second important component, you have to create the demand itself. Today, if you ask, many people have not even heard about pension, right? While we are discussing, but if you go and speak to a cab driver, if you go and ask to a farmer, have you heard about pension? When you look into the agriculture sector, when you look into the informal sector, the kirana shop owners, even some of the cab drivers, they're beyond 60 years. They're still working, Parul. So I think they've not even heard about pension, right? So who takes the role? Is it the public sector or is it the private sector? Is it the regulator? I think it's a role of everyone, Everyone has to come together.
I agree with you more. Unfortunately, Jayashree Ben did not, could not, but in my discussions to this, she had clearly said, she says another factor is trust. So who is it who's standing in front to offer these financial products to the informal sector worker who's standing in front? And in her experience during the pandemic, the women who had been regularly saving before have continued to save marginally more during the pandemic than the others. So there is a case study when it says that people, I may differ a little bit, Ayandev, that I think people want to save. They understand long-term, short-term, and in their heads, pensions is something that only the formal sector gets. And there have also been experiences where, the rickshaw puller who's 60 years old really doesn't want to work and the fact is that he has to work because he's not saved enough. So again, to Amlan's point, it is really the two sides the same coin. So just fireside question,
Just
and
1
this is,
second, I have to interrupt. This is, somebody raised a brilliant question. There is a vested interest that the experts start thinking they know what's the best. So these solutions, as Ayandev and Greta, etc., know, need to be developed and crafted carefully on the ground as simple solutions that the taker understands. Otherwise, they're going to be futile. So communication, product design, and encouraging people is a joint exercise for society. But if only experts be involved in it, it's going to fail.
I agree with you. I completely agree with you. So last question. So what, according to you, are the two most important steps that we should take to achieve higher levels of savings, insurance, social protection? I'll start with you, Greta. I'll start with you.
Well, I just want to come in on the conversation that we've just had, because I think it does lead to what I'm trying to say. I think, and I think this issue of financial health is really important and interesting. And if you look at some of the early research that was done on financial health in the United States, you could be low income and still be financially healthy. It wasn't completely correlated with your income level. So there is something about good habits, just good sort of ability to think about the future, right? And so I think there is an important role to sort of empower people. And I thought what Dr. Roy was saying about, nudging people towards good behavior is really important. But I think, the other thing we have to recognize is this pandemic is like, people are running out of their savings, right? I mean, people are burning through savings in the United States, and the government hasn't yet figured out a way to step in and help. And so this pandemic is off the charts in terms of people's ability to be resilient. And I think in my country, it's really opening up a conversation about the role of the private or the public sector that we have not had in 40 or 50 years, right? I think people are seeing that you need the public sector to step in. And so I think any of this is going to be kind of public-private partnerships. And I think that's to be welcomed. We actually had conversation in our presidential election about UBI. Like, that wouldn't have happened 20 years ago, right? That's not saying that we're going to do it, but I think people are recognizing that we need a floor, we need a safety net. And I don't think that happens just by relying on the private sector. I think we need to mobilize the private sector. I think we need to enable individuals to listen to their better angels, to build financial health. But I think there's a really important role for the public sector as well.
Thanks, Greta. Last comments for you, David.
Yes, basically, I think that I agree with what Greta said. First, I think that COVID-19 provides us an opportunity in order to make more efforts, in order to develop solutions for savings, particularly long-term savings. Okay, this is first. Secondly, I think that this is also an opportunity because for the first time, I think that people is aware about the need to construct a buffer in order to face situation like this. Also, I think that this is the first time that they take also conscious, at least intuitively, about the importance of insurance too. Okay, so I think that this is a great opportunity in order to develop, as I said before, a good relationship between government and the private sector in order to see what are the best experiences that both have been developed and try to complement forces in order to provide finally a broad access to financial solutions to people.
Thank you for that, Dr. Tusta. Ayandev?
Yeah, thanks, Parul. If you ask me on this COVID or post-COVID, the thought process and the attitude towards saving, borrowing, and credit has changed for good. So one thing is we should not lose this momentum. And while I say that, Parul, always we have been trying to say, look at the affordability, not having enough money to save. I think our focus should now change. We should now try to address not knowing how to save and not knowing where to save. I think if we can address these two, like where to save and how to save in this given scenario, because people are with the money. And I think one of the ways of doing it is either through digital financial inclusion, look at the digital space, because that is what even the COVID wants for, right? And second is an integrated approach, which I'm again and again saying, it has to be based on a PPP model with roles and responsibilities well defined.
Amlan, last comments, please.
Yeah, I will just echo what Greta said, and let me start off by showing you something which has made me very unpopular with Americans. Most health inefficient country in the world, also the most retirement unequal country in the world, with 27% of old age population below the poverty line. And also, three people now control roughly about 47% of private wealth in the United States, as opposed to 27% below poverty in Germany, Norway, etc. You've got about 2 to 6% below poverty. I want to also totally echo what Ayandev said, but heart of everything is communication and understanding at grassroots level, whether it's microfinance, whether it's digitization, etc. And collaboration is definitely needed across public private sectors. I do not think that people have appreciated the need. They've seen the need right now, have appreciated the need, particularly amongst middle and high income groups who have job secure, of how much they need to create a buffer. Think about the following, and I'm going to end with this. 76% of labor force in the G20 rich countries is services oriented. So countries like Japan and Italy are already going to take 5, 6 years to recover, just like emerging markets. So the whole system will need to change, not just in poor countries, but also in rich countries. And the country which is taking the lead, because it's the only country which can grow today, unfortunately, because they are totally free to do so in their 14th five-year plan, is China. So health and education really remain the key concerns, and every country, including India, including US, including UK, have got quite exposed during COVID. We really need to reinvest and rethink solutions there.
Thank you. Thank you so much. We're almost out of time. But Amlan, just to your point, if America is like that on their social security, 8 out of 10 people by 2050 will be living below the poverty line, who will be elderly in Asia, Africa, and Latin America. And there is no way that there's going to be a comeback from there at all. So just last points on coming out on savings, short term and long term, requirement for public private partnership, requirement for bundling of products to require people to access savings, including insurance, savings, credit, and insurance, looking at affordability, designing products to lift the woman. You lift a woman, you would uplift the entire community. So I'm going to end it at that. Thank you so much all for joining. Greta, Dr. Tusta, Andev Saha, and dear friend Dr. Roy. Thank you so much for joining. I'd also like to thank a lot of our attendees, Ashim Joy, Emma Amit, Charvi. We worked on pensions with her. Deepti, thank you so much for your questions to Dr. Amlan Roy. Enos, Farooq, thank you so much. Partner in crime for business, Gautam Bharadwaj, thank you so much. You're hiding behind the curtains. Herbert, running the Ejoheza program in Rwanda. Pleasure to have you here. Jaspreet, UNCDF, thank you so much. Kulin Patel, Shahidji, Mohammed, Murli worked on micro pensions, now looking at micro insurance. Nicolette, thank you for staying all through, regulator at the Caribbean. Nikhil, Nisha, Razaji for the first ones to join and still here. Ruchi, Mr. Bhatt from Friends of Women's World Banking. Sarita, Sujata, Sandeep, who runs Zamara, the one I mentioned. Varsha Marathi from the World Bank, and Wayne, dear friend from South Africa. Thank you so much all for being here. We've had a participation of over 50 people, so Greta, more than we expected. Thank you so much. We'll keep the series on at the pinBox webinars and come up with more topics and keep you appraised. Thank you so much all for joining in. Thank you.
Thanks a lot,
Bye.
everyone. Have a good
Bye.
weekend.
Thank you. Thank you so much.